Curt, thank you so much for joining me today here at PPIF. Tell me about the current trends that you've observed in the industry.
Well, certainly many more investors are getting involved in the private placement market. Every year, see new investors down here that show up, and there's increased appetite to add private investments to their portfolio.
Can you tell me about perhaps the criteria that you consider for private placement opportunities when you're thinking about your approach to them?
Yeah, I think, going back to your last question, another trend that we've certainly seen is more financial issuers coming to the market, BDCs, funds of funds, more so in the last few years than we've ever seen in the private market before. Criteria that we look for, RGA is first and foremost a credit shop, so it has to be a solid credit and show a relative value premium over comparable public bonds. As we continue to grow, we have a need for more private assets to grow in our investment portfolio, as we've grown about 20 billion assets under management just in the past 2 years. So it's been an exciting period of growth, and to look for solid investment grade issuers that offer a premium to public bonds.
And we've observed the growth of private markets and it proliferating like many industries really. What assets are you most excited about?
Certainly industrial credits. Obviously, we've done some financials as well. About 2/3 of the issuers in the private market aren't available in the public market. So it's a good diversification tool for investors as they expand their investment portfolio. So the diversification, the spread premium over public bonds, the access to management that you have in the private market, being able to speak with the CFO or the CEO directly, and the covenant protections that you get in private placements that are not offered in publicly held securities. So if something goes sideways in the credit, you're back at the table, you're negotiating with the company, you're pari passu to bank lenders, and it leads ultimately, if there is a default, a much better recovery than the typical 60% recovery you get in public bonds. It's much higher in private placements.
Obviously, you just outlined a very clear strategy, thinking about the pros and cons of every decision you make. But risk management is still quite a big part of the investment decision making. How are you handling that in the current environment?
Yeah, well, we have a formal process of twice a year making sure we look at all the names in our private portfolio. We monitor on a quarterly basis the compliance reporting that the companies are required to submit, where they stand in relation to the covenants that are in the note purchase agreement that the company needs to live up to, and monitor, on an ongoing basis, how the credit is performing, especially in relation to, original expectations, original forecasts when we underwrote the credit at the beginning.
Curt, thank you so much for joining me today and sharing your insights.
Great, thank you.